In this week's video, we'll examine numerous charts to help us answer the question, are the odds of a stock market correction increasing? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. If you were in the markets in 2010 and 2011, you might remember the S&P 500 had a big run-up and then a multiple month period of sideways consolidation, followed by a sharp correction in stock prices. Also notice, once support was broken here, the S&P 500 didn't bottom until several weeks later. So in this week's video, we'll look at some yellow flags that were waving in 2011 and compare them to 2015. But before we do that, let's take a quick look at what happened in the last 5 trading days. Notice here in 2011, prior to this waterfall decline and multiple week correction, the S&P 500 made a discernible lower high followed by another discernible lower high, a lower low relative to this period here, and another more important lower low and break of support here. This is a daily chart of the S&P 500. We're back in 2015 as of the close on Friday, May 15th. Unlike that period in 2011, we do not have a discernible lower high. In fact, we've made a discernible higher high, exceeding what was previously resistance, and we really don't have any important lower low either. So the price chart looks better. What about slowing momentum as measured by MACD relative to this breakout? This is a monthly chart of the S&P 500 in 2015. This is MACD. It measures longer term momentum when we look at it on a monthly chart. A bullish look is when black is above red. This is a concerning or bearish look from a probability perspective, and it tells us that the probability of bad things happening have increased. A logical question is this relevant? Yes, it's relevant. It's something that's tracked by the market model. How concerning is it? The short answer is it is not a showstopper, especially when taken in isolation. This is a monthly chart of the S&P 500 using monthly MACD with the exact same settings. Between 1982 and 2000, we had 1, 2, 3, 4, 5 bearish crosses that occurred during this period. Despite those negative signals from a probability perspective, you can see stocks did extremely well. So a monthly MACD cross is just part of the weight of the evidence. It's relevant, but by no means is it a showstopper. If anything, sometimes you get a cross just prior to a big move, a cross just prior to a big move, a cross just prior to a big move. Back to our 2010-2011 look, we're going to examine some charts in this period here to see if there were yellow flags, observable yellow flags that were waving, telling us that the probability of bad things happening was increasing here in 2011. Then we'll compare those yellow flags to the present day. We'll explain these concepts once and then use the same concepts on numerous charts. This is 2011 here. The waterfall decline in stocks began in early August. So we're looking at the period prior to the correction in 2011. Yellow flags waving here. This chart's telling us that the demand for safe haven treasuries was increasing relative to the demand for growth-oriented stocks. This is what we call a full-bore bullish look, which occurs here. Blue is above red. The slopes of both moving averages are up and prices above both moving averages, telling us that the probability of TLT outperforming SPY is higher right here than it was here. How does the same chart look as of the close on Friday, May 15th, 2015? This is a full-bore bullish look or risk-off look in favor of treasuries. The present day doesn't look anything like that. In fact, this ratio made a new lower low on a weekly chart, which is quite a bit different than the new higher highs that the ratio was making in 2011 before stocks corrected. Now we're looking at a bearish bet RWM shorting small caps relative to the S&P 500. It makes a low, then it makes a higher high. This is a higher low followed by a higher high before the correction begins. This is a full-bore bullish look. We can see it in favor of shorting small caps. The present day still favors SPY. The ratio has a full-bore bearish look and remains in a downtrend. When fear starts to pick up, the demand for mortgage-backed bonds starts to increase relative to growth-oriented stocks. Yellow flags in July. We don't have those yellow flags today. In fact, the ratio just made a lower low on the weekly chart. How about an ETF related to fear or the VIX? We get a bullish cross in favor of VXX in July before the correction starts. This is a full-bore bullish look in favor of VXX over SPY. In the present day, we have a full-bore bearish look against VXX and favoring SPY, and we're making a series of lower lows and lower highs in recent months, which is the definition of a weekly downtrend. High-yield bonds relative to the S&P 500, yellow flags waving in 2011. This doesn't really look anything like the present day in 2015. When fear starts to pick up, especially in the early stages, some equity-only managers will start to gravitate towards dividend stocks or blue chips. You can see they started doing that in February of 2011. The yellow flag started waving here. Again, the correction doesn't start really in earnest until early August. Yellow flags here in favor of owning conservative dividend payers. The present day chart really doesn't look anything like this. This is a low, this is a low, this is a lower high. This is a bearish look here with blue dropping below red. S&P 500 starts to correct sharply here in August. Corporate bonds relative to the S&P 500 waving yellow flags for several months. This is a higher low, a higher low, a higher high, a bullish cross, and a full-bore bullish look that we can see before the correction starts in August. And the correction didn't end until October of 2011. 2011 chart really doesn't look anything like the present day chart. Europe was a big concern in 2011, and Europe is still a big concern. But how concerning? This is a concerning look here. This is telling us that the demand to own EWI Italy is much, much lower than the demand to own the S&P 500 here. In the present day, it's just the opposite. The demand or conviction to own Italy in 2015 has been increasing relative to the demand or conviction to own a much more conservative S&P 500. This look here in 2015 in the present day looks nothing like this. How about safe haven gold waving yellow flags several months before the correction in the summer of 2011? In the present day, this chart goes back to 2013. The conviction to own gold is clearly in a downtrend on a weekly chart relative to the conviction to own growth-oriented stocks. Could this chart here morph into something like this? Yes, it could, and it could start next week. But we don't anticipate that. We want to see evidence start to accrue. This is a yellow flag that happens before. We really don't have any yellow flags yet. This is a lower low, and we haven't made a higher high of any significance. If you're pessimistic about the U.S. economy, that means you probably also think the Fed is not on the verge of raising interest rates, and you may also have a tendency to chase yield. REITs or real estate investment trusts tend to kick off a good dividend, IYR, waving yellow flags. I'd rather be in a dividend payer early in 2011 before the correction. Here, we're making a series of higher highs and higher lows, and we have price above both moving averages, blue above red, and the slopes of both are up. Today, looks nothing like this. This could change, but most recently, a lower high and a lower low relative to this low, and a full-bore bearish look against IYR relative to growth-oriented stocks. This is the weekly chart of the VIX that we cover often in these videos. Any yellow flags here? Not yet. This is a daily chart of the Nysc Composite, a chart that we've shown for several weeks at least in these videos. Regular viewers will remember that we used these markings here to say that this was leaning bullish. Why? Resistance, resistance, resistance. This is different here. It was able to break above resistance. And instead of going back and backfilling to this line here, as we did here, here, and here, we have white space here. And since then, over the past few weeks, when we said from a probabilistic perspective, this and this leaned bullish, the Nysc Composite made a new daily closing high on Friday, May 15th. Remember, in 2011, prior to the correction, we made a discernible lower high resistance on the weekly chart of the Nysc Composite Stock Index, price rejected. Resistance, price rejected. Bullish breakout, and now we've made a higher low and a higher high. All things being equal, from a probabilistic perspective, the longer we can stay above these levels, the better. If the bears can retake these levels, then the probabilities start to deteriorate. Just an update to our long-term Nysc weekly composite that goes all the way back to 2006 here. You can see we're starting to drift away a little bit from this consolidation period. Our S&P 500 extreme reference points, full-bore bearish look here in 2008, full-bore bullish look here early in March of 2009. The present day chart looks a lot more like this than it does this, telling us that the probability of bad things happening as of the close on Friday, May 15th, is lower than the probability of bad things happening in August of 2008. Same concepts here, we're just using longer duration weekly moving averages. A full-bore bearish look is when blue, the fastest moving average, is on the bottom. A full-bore bullish look is when blue is above the rest of the moving averages and price is also above all the moving averages. Full-bore bearish look here, full-bore bullish look. The present day, as of the close on Friday, May 15th, looks a lot more like this favorable period in 2009 than this unfavorable period in 2007. Is it possible that beginning next week, this 2015 weekly chart of the S&P 500 will begin to morph into a look like this? The answer, absolutely, positively, yes. But from a probabilistic perspective, Notice, typically you have time. You can see deterioration. Anything can happen in the markets. So we'll keep a flexible, unbiased, and open mind as we head into next week. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.